derivatives and related accounting issues. In this video, we will continue the discussion of learning objective number 7, demonstrate how fair value hedge is used and account for such hedge. In this video, we will discuss an example. The example is as follows. Assume that on April 14, when the current spot rate is $172, company makes firm commitment to sell 3,000 tons of inventory at the end of June for $172 per ton. We agreed to sell 3,000 tons of our inventory on or at the end of June. We here still on April 14, but we agreed to sell our customer inventory by $172 per ton on or at the end of June. It's estimated that the cost of inventory sold under the contract will be $430,000. The prices may increase and that the firm commitment will prevent the company from realizing even a higher sales value. On April 14, the same date of agreement or the same date of providing the commitment, the company enters into forward contract to buy 3,000 tons of identical inventory at the current forward rate. Why we entered into this kind of forward contract? To protect us against what? Against increasing the cost of goods. We entered into forward contracts to buy 3,000 tons of identical inventory at the current forward rate of $173 per ton. The forward contract expires on June 30, the same date of commitment. The forward contract will gain in value of a price increase because the holder will be able to buy inventory at the lower price of $173 per ton. Here we entered into forward contract to buy 3,000 tons by $173. In the same line, we have provided commitment to sell 3,000 tons by $172. The cost of goods is estimated to be $430,000. Let us see the given data on the different appropriate date of preparing the report. Notional amount in tons here, 3,000 will be the same in the different periods. Spot rate per ton, 172 on the date of agreement, increased to 174, increased to be stable in the next month, and increased at the end in June 30 to 176. Forward rate per ton for remaining time, 173, 175, 74, and 76. Initial forward rate as show here 173, 173, 173. The point is, be careful. Here in this example, we entered into forward contract to do what? To buy inventory. We entered into forward contract to buy inventory by $173. Here the prices has been increased. Be careful. We entered into forward contract. We have fixed price to buy the quantity by 73, but the prices has been increased into 175. So the question is, did we earn gain or loss? In this example, we have fixed price to buy inventory by 173. The prices were increased to 175. It means we have, because we have entered into this kind of forward contract, we have gain because we will buy by 173 where the prices increases to be 175. Here, how we will calculate it? Original forward rate 519, but current forward rate 525. How did we calculate it? 175 multiplied by the quantity 3,000 ton. Here we are talking about the forward, the value of current forward equal 525, but The forward that we entered or agreed to enter to is 519. How we calculated? The forward rate that we were entered to is 173 multiplied by 3,000 ton. Here we have entered into contract to pay 519, where the value of this contract on the date of preparing the statement or report is 522. So the amount that we will pay is less than the amount or the value of this contract. So here we are talking about the difference of 6,000 as gain. Be careful as we entered into forward contract. Is not standardized, it's customized, and we traded it in not regulated exchange. So here you have to calculate the present value of the amount. We don't calculate present value of gain or loss under a future contract, because already it's considered in the future exchange. In the market itself, when they price the future contract, already the difference between or the differences from day to day is considered. The differences is considered according to the present value. It means the prices is the present value of the difference. But here, because we don't trade it in the regulated exchange, so we have to calculate the present value. Here we are talking about discount rate is 600%. Monthly discount rate is 0.5%. So here we are talking about 2 months, on April 30 to June 30. We are talking about May and June in total. So we are talking about 2 months. 2 months multiplied by the monthly interest rate. Monthly interest rate is 0.5. 600% is the annual interest rate divided by 12 months. So monthly interest rate 0.5. 2 months 6,000. So the present value of the amount of gain equal 5,900. Okay, let us move to see how we will record it. Here we have we have gain because we have entered into forward contract. So forward contract will be debited as by 5,940, the present value of the amount of gain. Gain on forward contract will be credited by 5,940. On the other hand, as we entered into commitment, or as we provided commitment to sell a certain amount of our inventory, so in this case we have, on the other hand, we have loss. Why? Because we agreed to sell it by 172, as mentioned here. We agreed to sell it by 172, where the price is increased to 174. So we are talking about the same amount of difference, $2, and calculate the present value of it. So the same amount, loss on firm commitment, that you have to record it because you have commitment to sell this amount of inventory, 3,000, by 172, where the price is increased to 17. You agreed to sell it by 172, where the price is increased to 174. So we have the same amount of loss on the inventory as we provided commitment. So loss on firm commitment by 5,940, firm commitment as liability credited by 5,940. Let us move to the next period on May 31. Here already we have adjusted it from 173 to 175. The prices has been dropped to 174. We have adjusted the purchasing price by 175. Here the prices as we are going to purchase has been dropped to 174. It means in this case the prices that we have adjusted according to is 175. the prices has been declined to 174. So in this case, we are talking about amount of loss. Here, the original forward is 519. The current forward is 522. So here we are talking about amount of loss by 2,955. The amount is 3,000, but as we discussed a minute ago, you have to calculate the present value of this amount. How we calculate the present value? 3,000 divided by 1 plus the percentage of interest rate to power of what? The periods. Here we have 2 months. So it's 3,000 divided by 1.5 to power 2. Okay. So here we have loss by 2,985 as we calculated the present value of 3,000, and you have to deduct this amount from the amount that already you have calculated. You have recognized it, 5,900. So 5,900 gain minus the amount of loss, 2,900. So here we are talking about 2,955, the amount of loss. Loss on forward contract 2,955. Forward contract will be credited by 2,955. As we provided commitment to sell this amount of goods, by the same amount we have loss. We have gain. On the other hand, firm commitment debited by 2,900 as we provided this commitment. Here the amount of liability will decline by this amount, 2,900. On the other hand, we have gain on firm commitment by 2,955 to record the change in fair value of firm commitment. We will continue by the same way to calculate June 30. On June 30, we have, or the prices, initial forward rate per ton for remaining time here, 176. And the initial forward rate, 173. Here we are talking about $3 per ton. $3 per ton multiplied by 3,000 ton. We are talking about $9,000 as gain, as the prices increased from 173 to 176. Already we agreed to buy it by 173, but the prices has increased for 176 as we entered into forward contract. In this case, we have gained by 9,000 in total. But be careful, you have to deduct the amount of loss of previous period or already recognized in previous period. So here we are talking about 6,500 as gain. Forward contract of June, forward contract 6,015, gain on forward contract 6,015. On the other hand, you have loss on firm commitment. You have to record it as you commitment to sell the goods by 172 as the prices increase to 176. Here you have loss. The difference, as we discussed before, equal the same amount of difference. So here we are talking about a loss on firm commitment 16,000, firm commitment credited by 16,000. We have settled the forward contract, so we will receive the amount of gain. Here calculate it, forward contract debited by 5,940, again credited by 2,915, debited by 6,500. The net amount that we will receive equal 5,940 minus 2,955 plus 6,015 in total equal 9,000. So we will receive 5,000 to settle the amount of, or so to settle the contract itself. Cash will be debited by 9,000. Forward contract will be by credited by 9,000. On the other hand, we have commitment to sell 3,000 by 3,000 ton by 172. Here we have provided the commitment. We credited it by, first of all, 5,940, debited by 2,940, and credited at the end by 6,015. So we have liabilities by, or firm commitment by 9,000. We have to settle it. Here we will receive, we agreed to sell it by 3,000 by 172, so the amount of sales 520. How we will receive it? We will receive the amount of cash that we agreed to sell it, 516, that is 3,000 multiplied by 172, 516, and you have to settle the amount of commitment, and the amount of sales is credited by 522. As mentioned at the beginning of the example, the cost is 430. Here, cost of goods sold and inventory. Cost of goods sold is debited by 430, and inventory is credited by 430. By this point, we have finished the discussion of learning objective 7. We have discussed 2 examples. In the coming video, we will move to discuss learning objective number 8, how to disclose, or what's the accounting treatment of cash flow hedge. Let us see you there.